friends, it's Natalia with Custom Accounting CPA. Welcome back to Tax-Savvy Small-Biz advise you. Think of your money like a crop that you are planting. There are 3 stages to every crop. You plant the seed, that's your contribution. It grows, that's your compounding. Then one day you do the harvest, that's your withdrawals. The government can tax you at the seed, the growth, or the harvest. And every type of account has a different mix. So the real question is, do you want your tax break today or do you want it later? So let me walk you through how this plays out. I'm going to keep this plain English, no textbook lecture. First, just a plain taxable brokerage account. Like buying Apple stock in a regular account, you put in after-tax dollars, so no deduction upfront. Growth, dividends are taxed, but at special lower rates, and you don't owe on gains until you sell. Harvest, if you hold more than a year, you get those sweet long-term capital gains rates. And if you die with the stock, your kids often get a step up in basis, meaning they can escape the tax on all the appreciation. Pretty nice. So next type of the account, traditional IRA or 401k. Here is the big attraction, the deduction upfront. You plant your seed tax-free. Growth is tax-deferred, but harvest, that's where the IRS says, hey, remember us, every dollar you take out is gains that normally would have been taxed cheaper, like in my previous example with the regular investment account. And starting at age 73, you must start taking money out, whether you need it or not. Plus, those withdrawals can make your Social Security taxable and push up your Medicare premiums. Not very good. Next account, the Roth IRA or Roth 401k. No deduction today. You pay tax on your seed. Growth. Same as traditional, tax-free while it grows. Harvest. Beautiful. You can take it all out tax-free. No required minimum distributions in your lifetime. Your heirs still have to empty it within 10 years, but this is tax-free for them as well. Non-qualified annuities. Honestly, this is not my favorite. No deduction upfront. Growth is tax-deferred, but when you pull money out, you pay tax at ordinary rates, not capital gains, and the IRS makes you take out the taxable part first. That can be pretty painful. Next one, cash value life insurance. That's like Roth cousin. You don't get a deduction upfront. Growth happens inside, tax-free, and you can take money out in smart ways. Basis withdrawals first, then loans against the rest, which both are non-taxable. At death, your heirs get the death benefits tax-free. Done right, this one is powerful. Done wrong, and it's messy and expensive. And finally, the superstar that not enough people use is the health savings account, the HSA. This one is crazy. You get a deduction when you put money in. It grows tax-free, and if you use it for medical expenses, the harvest is tax-free too. It's literally the only account in the code that is triple tax-free at all 3 stages. Let's put numbers to it. Say you've got 10 grand. If your tax rate today is 35%, and in retirement it's also 35%, guess what? Doesn't matter, traditional or Roth end up the same. But if rates go up in the future, Roth wins. If tax rates, go down in the future, traditional wins. So the million-dollar question is, where will your tax rate be when you harvest? Well, that depends. Do you have rental income? Will you sell your business one day? Remember those required distribution at 73? They can push you into a higher bracket whether you like it or not. And let's not forget, our current tax rates are near historic lows. Do you really think Congress is going to keep them this low forever? We wouldn't bet on that. So let me give you a real example. Mid-40s, 7-figure income, everyone said stuff the pre-tax plan. But his rentals plus business value meant he would never drop out of the top bracket. If he showed everything in a traditional or even a defined benefit plan, his future harvest would have been brutal. Instead, we mix it up. We maxed HSA, filled employer Roth 401k portion, kept some dollars in brokerage for flexibility, and added cash value life insurance because withdrawals there can be tax-free as policy loans. Net result, lower lifetime taxes plus, no surprise, RMD required minimum distribution spikes. Story 2, another example. Late 50s, sold a business and took a 2-year breather before Social Security Medicare. Those were perfect Roth conversion years. Filled that 22-24% brackets, avoiding 32% plus later. Same dollars, different time, and thousands saved. So here is your action steps for this week. Do a quick bracket check. What's your tax rate today? Where will it likely be when you start taking money out? If you think rates will be higher later, go Roth. If you think they will be lower later, go traditional. And if you're eligible for HSA, health saving account, mark that first. It's a no-brainer. And always mark employer 401k. It's a must rule. Alright, and I've got a freebie for you. I put together a one-page guide called Seed versus Harvest. It shows this all visually, what we went through today, with the math side by side. If you want it, just type Roth in the chat, even if you're catching the replay, and we will DM it to you. And if you're ready to go deeper and see what mix makes sense for your business, scan the QR code or click on the link. We will map out your plan together. Just want to remind, don't miss next week. We will be talking about Roth conversions, the 3 golden windows for business owners. This is where you can save yourself from big tax bumps down the road. If this was helpful, hit like, share with a business owner friend, and don't forget, type Roth to get the guide. See you next week.